Apple, Microsoft. Maybe Apple may have checked out now, but Apple used to be always bigger than that. So it's always changed so much, so please keep happy. Okay. Fine. So if you look at, for example, if I show you, so there is a very good site. Of course, there are many sites. I have tried many sites, but I find this site to be very user friendly, and the data happens to be very accurate. I mean, a lot of people feel that the data is not good, but I have found, I had checked with all the balance sheets of the company. I found the data are very good. Let's look at company like Reliance. Okay, are you familiar with this site? How many are not? Please raise your hands who are not. Okay, so if you are not, so please go and subscribe to this site. It's a free site. Okay, open with an ID and password, and then it will give you a very good information to when you can look for any company you want. For example, Reliance Industries. Okay, which is on your screen. It is having a market cap of 20 lakhs 11,270 crores, and the share today is worth 3,000. Current price is 2973. Okay, fine. So maybe it has declined today, but yesterday it closed at 3,000. But the market is open right now, so it is the market may be down today. Okay, so look at the balance sheet, for example. So if you look at the balance sheet, this is the borrowings. Okay, this is the borrowings. So borrowings have been almost to the tune of 3 lakh 16,000 crores. So one of the highest borrowings by any company in India. Okay, and the borrowings have come down compared to the last year. It was about 4.5 lakhs. What's Reliance doing basically? What business in Reliance is in? It's a what kind of business it is? Oil and it's a conglomerate, yeah. So it is actually present into six businesses, okay? And oil to chemicals is one of their main business, okay? They are into digital business, they are into media business, they are into retail business, jewelry, apples, and everything, and they are into telecom also. So they are present into six businesses, and now they are pouring into energy business also. Uh, so they are into six businesses, and because oil to chemical business all depends on the price of the oil. Okay, it keep rising, going down. So they are venturing into retail fronted businesses, which are giving them a higher margins, and it is improving their profitability of the company. So if you look at Reliance, look at the figure debt to equity ratio, which means it is 0.42, which is very good. That means 42 paisa of debt versus 1 rupee of equity. Okay. So despite that they are huge debt, but still because the equity base is so high that the money given by the equity shareholders and the reserves, which are to the tune of about if you look at the balance sheet, so you find the equity is 676 crores and the reserves are 7 lakh 44. These are basically reserves created out of the past profits of the company, which belongs to the shareholders as the share capital. Okay, so they have huge debt, but if you look at the ratio of debt to equity, then they are doing very fine. They are 0.42. For example, if you look like companies like Adani Enterprises, for example. So look at their debt equity ratio, which is 1.56. So most of the Adani companies are in heavily in debt. So they are leveraged companies. Okay, fine. So it is always better to have a debt equity ratio below 1. Okay, of course it can be even higher and still company can do well, but it is it is affected by the interest rates going up. Then their profitability may go down, and then they have a risk of bankruptcy if they are not able to pay their debt in time. So look at yeah, you have some questions. So look at the balance sheet. Of course, the debt is 57,000 compared to Reliance is very small, but the equity base is only 36,000 crores. Okay, plus 114 the original equity. So so you find that companies which are having high debt, they have more interest burden, and those companies which are have low profit margins, they would be vulnerable to their profit shocks. Okay, bottom line can affect this thing. So I'm just closing down. Let's go back to Reliance one more. So this is Reliance. There's some data which is captured, because since I have logged in, so it is giving a lot of information which I have, added by adding to ratio table. So there are a lot of information which is very important. So I'll share you a snapshot of this so that you can also, add those ratios, because it gives you a complete picture of the Reliance, okay, or any company which you're looking at. So the book value is 1,110 crores, and the market value is 2,900. Okay. So what is the book value? What is the formula which you have understood? The book value. How do we calculate book value? Asset minus liability. The net worth of the company divided by the total number of shares will give you the book value. So all the companies, in India, they trade above the book value. All the companies which are profitable and which are, managed well, they will be always trading at a very high price to book value. As per the current scenario in India, average on India, there is a 4:1 ratio of the book value. That means the share will be trading 4 times than its book value. But when you look at, for example, Reliance, price to book value, is there anywhere? Can you see price to book value? 2.71. So it is trading. All the companies which are, have put a lot of money and have a lot of assets, so they won't be trading so high. But then we have to compare. When you compare this company with its peers, you will find it is richly valued. Okay. And again, their P ratio is about 28.8, and all India P ratio is close to about 22. So it is higher compared to the Sensex or the Nifty, but it's quite reasonable, and people have recommended to go with for this share. Anyway, I'm not going to do that. So then we come back to our interest rate risk management. So what is an interest rate derivative? Okay, an interest rate derivative is a financial instrument with a value that is linked to the movement of an interest rate. Okay, so it's a derivative of interest rates. Okay, so we have derivatives. So derivatives for stocks, derivative for currencies, derivative for commodities, derivative for interest. Okay, like this, we have so many derivatives. Okay, and derivatives are basically helping the companies to manage their risk, whether it is a currency risk, whether it is a commodity risk, whether it is a interest rate risk. Okay, and this is a very old kind of a form through which we manage our interest rate risk. And of course, there are things like forward, okay, futures, options, and swaps. Okay, like you can enter into make a forward agreement with someone to buy certain thing at a certain price. Long back, my father was running a restaurant business about 40 years back, and he has never gone to a school. So he entered into a forward contract with all the suppliers to supply, a 1 year forward contract to buy, tomatoes, onions, because we are a restaurant. So he bought everything: poultry, chicken, fish, mutton, for whole 1 year at the rate which was fixed for the entire year. Tomatoes were bought, say, 1 rupees a kg, potatoes at 50 paisa for whole year, because, we had about 300, 400 dishes in our menu. So price don't change very often. If the customer comes and if we find the price change, so he used to have a 1 year contract. And whatever price might happen to the tomatoes, it may go even 5 rupees a kg, that time I'm talking about, but he will still get a 1 rupee kg because he had a forward agreement with someone to supply tomatoes, potatoes, everything for 1 year. Okay, so he knew the art of managing the risk of his business. I'm talking about 40 years back, and he had not even known what is a forward, futures, and options. So this has been there from ages. People have been using them to manage their business risk. Is that okay? So they have forwards, futures. So forwards are basically, contract which are over-the-counter agreements where you enter into an agreement with someone. Okay, fine. So there is always a counterparty risk, because the other party may, like my father entered into a forward contract with someone to buy tomatoes, but he may not supply. He said tomatoes are now 10 rupees a kg, and we have the contract won. So there is no recourse. So you have to go to the legal courts and take the recourse. So there is always a risk of the other party not, observing and following the forward contracts. Okay. So forward contracts are used for currency, commodities, for anything. Okay. Similarly for interest rates. Then we have futures. So what's the difference between forwards and futures? Any idea? They are standard, but you have to go to the stock exchange. So forwards are over the counter, and futures are you have to go to the stock exchange. Okay, so you have to log on to the National Stock Exchange or Bombay Stock Exchange to enter into stocks, into futures for all kinds of derivative, whether they are interest rate derivatives, whether they are commodity derivatives, whether they are, of course, they have commodity exchanges separately. So for stocks and currencies, you can go to these sites. Okay, so I'll just show you a site where we can go and book our orders. So I have an ICICI account. So ICICI, I think I've just changed the. Okay, I think I just changed recently my login credentials, so I don't remember at the moment. I'll just go and check that, and I'll come back to that. So, so you can go to a site and book your order. So next time I'm definitely going to show you how you can go to the stock exchange and enter into futures trade. So we have another class next time. So interest rate derivatives are financials that we have done. So these are basically options. So forward, futures, and options. Okay. So what is the difference between futures and options? Any idea?
Future is an obligation, but option is a right to the buyer can choose to not choose or option.
Come again.
The buyer of an option can choose to not exercise his or her option,
Okay.
but that is not the case today.
So futures basically, if you have entered the contract, what will happen? You have to stay in the contract other before you close it. Either at expiry or you can close it well before also. So either you can make unlimited profits or unlimited losses. Okay, if you're not having any hedging position. So for example, I'll just give you a case. Uh, Suppose let's talk about a dollar, which is suppose today 82.80. Okay, dollar is currently trading at 82.80. Okay, and you require dollars. Okay, for example, you may require 1 lakh dollars. Okay, so this is dollar rupees. Okay, fine. So you require 1 lakh dollars. Say after 3 months from now. So now we are March running. So April, May, June, for example, you require somewhere in June 2024 these dollars. Okay, fine. So you can go to you can enter a forward contract. You go to a bank, okay, and say I require a dollar. So first is forward. So you go to the bank, and you say that I require dollars. Say in June 2024. So he will give you a quote, which will be say 83.05. Dollar always appreciates against the rupee. We all know that. Normally it can be other way also, but normally the dollar has a kind of a rise. So today, it is rising almost at a premium is about 1.5%, 1 year premium. Okay, it's the interest rate differential basically. The interest rate between US and India. Say India. So let's say India it is about say 6% rate of interest, and US it is 4.5%. So when we say interest rate, these are the bond rates. Okay, of course, bond rates are close to 7%. I'm just taking 6%. Yeah? Okay, and then I can take always this as 5.5 and take this. So bond yields are about 7%. The government is borrowing today, and they're borrowing at 7%. So interest rate in India is about 7%, and US it is 5.5%. So these are the government US interest rate yields, okay, which are 5%. The difference is how much? About 1.5. Okay, so which means that the dollar is going to appreciate by 1.5%. If this holds true, then 1 year down the line, if you look at a forward rate of dollar, it will be 1.5% more than what it is today. Why so? Because suppose there is a bread which is costing today say rupees 80. Suppose bread, good bread. In India is about say 10% for example, and America it is 0. So let's just to explain. Okay, suppose in India inflation is 10%, so that means the bread price will go to 88 after 1 year, isn't it? So that means if the dollar is trading today at 80, it will go to 88 because the US currency will not lose any value. It can buy the same thing in India, what it was buying a year before. So suppose in US it was about 5%. So then it will go up by say 5%, the differential, okay? That means minus 5. So let's say 84 is 5%. For simplicity reason, I have not calculated 5%. So it is the interest rate differential which causes the country which is having a low inflation which always will take at a premium compared to a country which is having a higher inflation. Is that, are you aware of that? And why it happens? Because if India is in inflation, so Indian goods are going to become costlier. So the dollar is, there is no inflation in America, so dollar will go up by the rate of inflation of India, so that it can buy the same thing what you were able to buy a year before. So only Indians are going to feel the pinch and not the Americans, because if they are earning $1, they can buy the same thing. Indians have to incur higher cost because of the inflation in India. So it's the inflation in India which causes the shift in inflation valuation. For example, if you see, dollar was at close to about 5 rupees in 1950, and today when we speak it is about 83. Okay, so if you work out, if you have put 1 rupee somewhere and it become 83 after 74 years, so you look at the rate, you get close to about 3.75%. That means if you have invested 5 rupees and it becomes 83 rupees after these many years, which is 74 years, if you calculate on Excel sheet, you will get a return of 3.75%. That means the dollar has appreciated in those 74 years at the CAGR rate of close to about 3.75%. And that is the interest rate differential between US and India traditionally. Of course, in America, the inflation has gone up after the Ukraine war, but it was about 2% there. India is about 6%, there about 2%, so inflation differential was close to about 4% or little less than 4%. Okay. So if you look at the current trajectory of the dollar is about 1.5%. So now I was just talking about the forward. So we went to the bank, he says 83.05. Okay. I was, my first job, I was working in Grasim Industries, and we were importing a lot of material from outside, and we had to make a lot of payments in future. So my boss called me and he said that we need to go for a forward contract. Those days, futures and options were not available on the stock exchange. So he says we have to take a forward premium. I haven't not heard anything about that at the time. So I went to, I was in Gwalior, again not in Delhi. So I went to State Bank of India, was the biggest bank in Gwalior at that time. Talking about 30, 35 years back, more than that. So I told them that consignment is coming, so I need to buy a forward contract on dollars. So they were also bamboozled. They said, what is this? We have not heard of such kind of a thing. So we'll check from our head office. And eventually we got it from the head office. So anyway, so here the forward contract is trading at 83.05. Now, which gives you that you can buy dollars at 83.05. Even if the dollar goes to 84 or 82, so this is the spot rate after in June. Suppose this is the rate which happens on the day when the transaction is going to happen. So I'm going to buy my dollars at 83.05. So if it goes to 84, I'm very happy. When it goes to 82, rupees more. Okay. So that means it protects you. Okay, it gives you a hedge, but you don't have the advantage of buying at 82 because since you have taken a hedge, you can't buy at 82 now. Okay. Similarly, in futures also the same thing. You could go to the stock exchange. Okay. And what happens? The forward transactions are very limited. Okay, it's basically used for only hedging. But in futures, there are a lot of speculators also sitting on the market. 99% people are speculators. So it's a wholesale market. So their chances are that I may get a rate which is say 82.95 in the futures market for the same period. So it will be always better to go to the futures market rather than go to the forward market. Okay? Because I will buy expensive dollar. Okay? Future market, the 100 people are only 1% is hedger, the rest are all speculators. So the price for the wholesale market, the price is always cheaper compared to the retail market. So imagine the forward market is like a retail market and the futures market a wholesale market. Okay. Now the last one is called the options. So in options, now what happens is you go to the market. Okay. So in forward and futures, there's a buyer and seller. Okay. In options market also, there's a buyer and seller. So seller is called the writer. Okay. And buyer is called the buyer, option buyer. So you can either take a call option or a put option. So options can be either a call option or a put option. Okay. So if you are an importer, you're going to take a call option. Normally. Okay. And if you are an exporter, you're going to take a put option. So it is the contrary this thing. Call option, you make money only when the dollar goes up compared to the rupee. Okay. So you are going to gain in your contract, but you are going to lose in your underlying position as an importer. If the dollar goes up, you have to make more payment. If you're not hedged, that means the dollar goes to say, for example, say you have chosen a price of 83. Okay. So if the dollar goes to 84, 85, and you are not hedged, so you have to pay more, you have to pay higher price. But here, since you have taken a call option at 83, fine. So it's called the strike price here. Okay. So you have to choose a strike price. Are you aware of the strike price? Strike price has a premium. So you choose right close to the money strike price, which is close to the current spot rate prevailing, which will have a premium which will be quite reasonable. If you buy in the money option, the premium will be high, so you can lose the premium. So the person pays a premium. Like to give an example, suppose you want to watch a movie, okay, and you bought a ticket for 500 rupees, and the movie is going to be next week, and somebody told the movie is not good. I mean, it's worthless. I mean, this is wasting your 3 hours. You don't go and watch, and you agree to that person. What will happen? You will not go. You will lose the ticket price. Okay. So you get a right, but no obligation to watch the movie. If the movie is not good, you're not going to watch it. If the movie is good, you're going to watch it. So similarly in options, you're going to feel that it is good, then you're going to exercise the option, otherwise you're going to come out of the options. So you only lose the premium. So what you have to pay a premium, okay? Like for example, insurance. We take insurance of the car. We pay a premium, 20,000, 15,000, whatever. Okay. During the year, nothing happens, you don't file a claim, so you're happy. You lose your money next year, again you have to take an insurance premium. But if anything happens, you will claim a lot of money from the insurance company. It can be the whole value of the car. If the car is stolen or damaged fully, so company is going to pay. So here, there are two people, the person who buys an option and the person who writes the option. So writer is like an insurance company, so he is giving you an insurance. Okay. So he can make only insurance premium. His profit is only insurance premium, whereas the other guy can lose only the premium and can gain maximum. If you can claim the whole value of the car if the car is risky. So he has unlimited potential of making money, but unlimited potential of losing money, that is only premium. And the call writer on the other hand has an unlimited potential of losing money, but a limited potential of making only the premium. Is that okay? So now you choose a call strike price of 83, which is close to say current price 83, and you paid a premium. Suppose you paid a premium of say 50 paisa per dollar. Okay. So which means $1 lakh multiplied by 50, how much it will come to? 5,000? 50 पैसा है ना ये, 1 रुपया होता तो 50,000 हो गए. Okay. So you paid. I'm just going to make it look little bit reasonable. Okay. So it is 20,000. So you paid a premium of 20,000. Premium was 20 paisa. Fine. The premium is close to about 20 paisa or 18 paisa currently at the call to money. Okay. So you paid a premium. So you paid 20,000 rupees as I'm going to just write it properly. So you paid a premium of 20,000. Now what happens? There can be two possibilities. The price goes to 85 or the price may go to 81. Okay? Fine. So 85, you will exercise the right because the price has gone to 83 and it is sitting on a 3 rupees profit. Okay? So you are going to get 2 rupees multiplied by 1 lakh. So it will be 2 lakh rupees profit you are going to get. Isn't it? You are going to get 2 lakh rupees profit. Okay? But you are going to lose 2 lakh rupees in your underlying transaction. When you pay to the importers, you have to pay 2 lakh more. Okay? But this will come at a cost of 20,000. I think cost is 20,000. Is that okay? So if the dollar price goes up, you are going to exercise your right and in cash 2 rupees and the writer will give you 2 rupees equivalent of 2 lakh rupees, okay, which is, because it has gone up by 2 rupees, 2 rupees multiplied by $1 lakh gives you about 2 lakh rupees. But then the day will come, your banker will say, okay, you have to make a payment for the dollar. Today is 85 rupees, so you have to pay 85 lakh rupees. Isn't it? So, but he has paid 2 lakh rupees, he has got a benefit of 2 lakh rupees. So his outgo would be only 83 rupees, isn't it? Fine. Is that okay? His total outflow will be only 83 minus the premium. That's all. So he's happy because today the dollar is ensured that he is going to get the dollar at close to the current price of 83, the strike price what I achieved. But suppose it goes to 81, he's going to say, no, I'm not going to exercise. Movie is not good, I'm not going to watch it. So what will happen? He is going to, lose only the premium, which is 20,000, but he's going to pay the importer at 81 rupees. So his cost will be 81.20 only. Fine. Is that okay? So in options, you can always come out of the contract if you want and be in a winning position. Okay. So then of course there are swaps. So we did forward, futures, and then options. And I'm going to share all this which I've covered in a video, so you can watch it. Yeah. So that's a very good question. Okay, because what happens in India, the options are priced in such a way that almost 80% of the time the call option writer is not going to exercise his option and he's going to lose the premium. Okay, it is very expensive. Options are so expensive that the dollar is not going to go past the premium. Okay, suppose I had taken up at 83 and the premium is 20 paisa, so that means after 83.2 I'm going to make money, isn't it? Fine. So if the dollar closes well before 83.20, I'm not going to exercise my options, so I'm going to lose my money. So 80% of the time the option writer makes the money, and 20% time only the call option buyer exercises right. So now then, if it is so expensive, then what is the fun of going to the options market? So only thing is there are two ways to check whether the option is very expensive or it's cheap. First of all, you get an option at 20 paisa. Okay, so you want to know whether it is cheaper or whether it is expensive. So there is some model called Black-Scholes model, which you might have done in your life. Have you? So there is a model which is called Black-Scholes model. You can just go and Google it. So you apply that model. The two guys, Blacks and Scholes, they were Americans. They developed a formula which they could calculate the premium for a particular strike price. Suppose the premium comes to only 10 paisa, according to Black-Scholes, and he's charging 20 paisa. So that means he's overpriced. Option is overpriced, isn't it? So if you work out, you are going to the options market and you see the premium is 0.2 paisa for the at the close to money option, whereas Black-Scholes model is saying it should be only 10 paisa. Okay, so that means option is expensive. So there's no point of going and buying a call option. In that case, you can write a call option. Instead of buyer, you become a writer. Chances are you're going to get premium, isn't it? There is other party. There are two parties, one buyer and one seller. Instead of becoming a buyer, you become a seller. If the option is so expensive, and chances are the writer is going to make money, so become an option writer rather than becoming a call buyer or a put buyer or something like that, isn't it? So there is a model which tells you, about it is based on the volatility. How volatile is rupee, dollar, or any stock or anything. So depending on that volatility, first we calculate the real volatility, and then we calculate what is the volatility which the option writer has built into the rupee dollar. Suppose he has built in a volatility of 50%, okay, and volatility is only 10%. That means the option has become very expensive. That he believes that the rupee dollar can go to any, in a range. So he's built in a lot of volatility, and if you understand the, go and research about Black-Scholes, it is based on volatility. Fine. You understand? You calculate standard deviation. Okay. When you calculate standard deviation, you come out, a standard deviation of 5%. That means it can hover between, plus and minus 5%. One standard deviation, or two standard deviation plus and minus 10%. Three standard deviation. So maximum it can go up to 3 standard deviation. 99% chances it can go up to only 3 standard deviation. Of course, 1% chance it can go anywhere. So if the standard deviation comes to 5%, rupee dollar, but he has built in say 15%. So that means he's charging a very high premium. More volatility built into the option premium, the premium rises. Okay, fine. Because if the premium rises because you have built in more, the premium, this thing volatility, okay. So because the option writer is worried, because if the price can go in a wide range, he can lose money. So he has actually put that volatility priced into this thing. So that means dollar rupee can be within the range of 15%. So he had huge money he has entered into the premium, assuming that volatility of rupee dollar is 15%, but actually it is only 5%. So the premium should have been very less. I think you have got it something, is it? So if you do some more research, you will be able to understand, and you get these volatility charts on the stock exchange. Okay, you can just immediately know whether the premium is higher or lower. Okay, and then make a call whether you want to go for becoming a buyer or a writer. Okay, so is this okay? Okay, so I want somebody to read. Who can read better and louder? हाँ, anyone? आप पढ़ सकते हैं?
Interest rate derivatives are often used as hedges by institutional investors, banks, companies, and individuals to protect themselves against market interest rates. But they can also be used to increase or imply the holders' risk from by or to speculate on ratings.
So basically, they can be used for hedging and they can be used for speculating also. So in stock exchange, if you're gone, you can speculate also. There is no bar in speculation. The only bar is, particularly for the currency derivatives, you can't go and go to the foreign apps and and enter into a future and options there, because then it requires a payment in dollars. India, if you are using Indian side, then you are making all your money in rupees. So there is no bar in speculation. India allows, okay, because why the speculation is allowed in India in all the derivatives, like it is commodities, stocks. Why so? Any explanation, please? Anyone? Why the derivatives? It's like a gambling, okay? Why? If you are just a mere speculator, you're just gambling, and 99% of people have to be gamblers. So why the gambling is allowed by the Indian government? Because there is a better price discovery. Because if there is only one person who is hedger, okay, and if you want larger participation and there are 100 people who are there in the market, so you will get a better price. Okay, like in a wholesale market, there are hundreds of people who are selling, apples, mangoes, whatever. The price falls there. So it is just for the purpose that there should be a better price discovery. So the government wants there should be a lot of players into the market, and of course the government has made a lot of rules, okay, to curb unnecessary speculation. Like about 2 years back, they say that there has to be now in the futures and options market, everything is cash settled. Okay, if you have bought dollars, you're not going to get dollars. In forward market, you will get the dollars from the bank. But in futures and options, everything is cash settled. Either you get cash or you pay cash. If you're losing money, you pay cash. If you're making money, you will get the cash. Like I gave you an example that you will get 2 lakhs from the stock exchange, you will get or loss. So, now recently, about 2 years back, the government said there has to be a physical delivery. If you don't close your position before the expiry of any stock, suppose you have bought Reliance futures, okay, and there is a 1 month window, so you can carry out the position of buying Reliance futures, but at the end you have to close it before the expiry so that it can be cash settled. If you don't do, then you have to actually, give a physical delivery of Reliance, which means that you have to first put a lot of margin money into this thing here.
So at the end of contract, when will be a buyer and a seller.
Yeah.
They have to
In the physical form. So maybe only if you have bought, somebody has sold. Okay, so he has to give you a physical delivery. So that means you should have a demat account. He should also have a demat account so that he can pass on the delivery to you. But if you close your position before the expiry, then everything is cash settled. Just 4 days prior to the settlement expiry period, which happens to be the Thursday of the particular every month, end of last Thursday. So before 4 days, stock exchange will ask you to deposit 100% of the money of the Reliance. Because they've taken a position. So they'll say you deposit 100% money, so you have enough money in your account. If you're not able to give delivery, we'll buy Reliance in the market and give delivery to other person. So the margin goes up, the cost goes up. So people try to close their position, well before the maturity, so that there is no delivery hassle. This is to curb speculation, excessive, because Indian markets are highly speculative. So those things are started in India. Okay. So any other questions? Just read.
entities with interest rate risk can use these derivatives to hedge or minimize the potential losses that may accompany a change in interest rate.
Okay, so basically it's again a hedge. We know that a person can always, use interest rate risk to, because if they expect the interest rates to go up, then I can take a position in either in the forward market, on the futures market, or swap market, or whatever. Okay, fine. So I'll just explain through an example so you'll be able to understand. Okay.
Derivatives are more often used to verify or else to speculate on the direction of futures.
So basically, they are more often being used for hedging instrument rather than basically speculation in practice. Okay. So now, before we understand and do an example how the hedging happens, like we have done in a dollar versus rupee case. So first of all, you must understand what are the interest rates. So yeah,
Interest rate is the cost of borrowing money, compensation for the service, and the risk of lending money.
just hold on. So interest is a cost of borrowing. Fine. Like suppose a bank, the cost of borrowing is what? So they are borrowing funds. Assume for a very simple reason that suppose I have a fixed deposit at the bank, and that is only like suppose I can have a current account, saving account, fixed deposit. Suppose I have taken a fixed deposit, and bank is giving me 7%. So what is the cost of a deposit? 7%. Company doesn't have any other money. Bank doesn't have any other money. They have to put 7%. So their cost is 7%. Okay. Now when any person comes to borrow the money, okay, so they will be always charging a higher than 7%. Okay, they will charge 8%, 9%, 10%, depending upon the credit worthiness of the borrower. Okay, looking at the rating, how this thing is there. If Reliance comes, they may say, okay, 8.5%. If you and me go, they'll say 14% because our chances of not, repayment of money is, default is very high. Okay, compensation for service and risk of lending money. So there is a compensation for service. They are providing you service, so they are incurring some cost for that. So there are people who are there, so they have computers, everything. There's a lot of cost, so they are going to inbuild that cost also, and risk of lending. Now it all depends upon the risk. Okay, so more riskier the borrower, higher would be the price for him. Less riskier the borrower, lower lending price for him. Interest rates, yeah.
Interest rates are always changing, and different types of loans offer various interest rates.
So basically, interest rates keep changing. Now, how does they change? We'll understand that. And different kind of loans will have different kinds of interest rates. Suppose I take a personal loan. Suppose I go to the bank and say I want a personal loan where there is no collateral. That means I'm not going to give any kind of a security. So they say 15% or 14%. If I say I have to buy a house, so I'm going to, give my house papers and give that as a collateral, then the rate of interest may be 8% because they are assured about that they have the house in there as a mortgage. Okay. So they will, interest rate will keep depending upon the types of loans.
The lender of money takes risk that the borrower cannot pay back the loan.
So there is always a chance of a default. So that is assumed by the banker, okay, and they know that they have a lot of data to make sure so that the cost may be inbuilt, okay.
Thus, interest provides a certain compensation for the bearing risk.
So thus interest provides a certain compensation for bearing the risk, okay. So that interest has to take care of that also, that there is a chance of a default also. Because if there is a chance of a default, if I go as a personal loan, they'll charge 14% from me. So they are already building into that cost to me. So it's not that everybody bears it. It's those kinds of borrowers who are borrowing without providing any collateral. So they would be charged the least. Okay. Now look at this rating. So this is a CRISIL rating. Okay, of the borrower. It's a long-term rating. So AAA, each rater will have their own symbols. So CRISIL has this rating, long-term. AAA, highest safety. AA, high safety. Like this, D will be called the default rating. Okay, fine. So let's go and check this on our site. For all the company, we can go and check, for any company. For example, Reliance, go to, documents here, and they will get rating upgrade. So here you can check what is the rating. So Reliance has, like a AAA, ICRA AAA rating for the recent, so every time the Reliance or any company goes and borrows money, they have to get their rating done. So for non-convertible deposit debentures like bonds, when they raise money, so the total number of bonds in terms of value was 18,500 crores. For that, the ICRA has given a AAA rating. Okay. For example, look at, for example, a company like, Vodafone Idea, which rating would be the least. Okay. Because the company is in losses. So go to, like, for example, documents here and go to the rating upgrade. So their rating would be a B plus rating. Okay, fine. And there's a rating called A4. This is for short-term borrowing. So for short-term borrowing, A1 is highest rating, like A1, A2, A3. As it goes, the rating falls. Okay. So for short-term money, a company wants to raise money for just for 6 months or 1 year, then it's called the short-term banking facilities and the long-term. So long-term rating, they have raised 12,203 crores recently. For that, the CARE B plus rating. So when you go back to the rating again, so you'll find that the last rating, which is triple B, is called the investment grade. So if you have a rating below triple B, normally banks are not going to lend you money. Okay, like India has a rating, sovereign rating of triple B. So we are just at the investment grade. The Standard Poor's have given India as a rating of triple B. Of course, we have been always fighting that we have been doing so well. Our economy is the fastest growing economy, and our rating should improve. But India has been given a triple B rating, which means we are at the last grade. So if our rating falls further, then nobody is going to give us money. Like Pakistan has a rating which is much below. So that's why they find very difficult to borrow money. They have to only go to IMF basically. No other agencies are going to give any money to them. Yeah. So the AAA rating doesn't guarantee your money, and always the rating agencies can make mistakes. They are always biased towards US companies as against the Indian companies. So that is being always a charge of India. Okay, so it's given by the rating agencies, and most of the people who are sitting on the board are all US people who are stand for their deciding what the rating. So they are subject to manipulations. Okay, so you can't 100% rely on anything in your life. But they are quite good. I mean, of course, India companies are doing much better job. Okay, fine. So interest rates. Okay, read.
Coupled with risk of default is the risk of inflation.
Keep
If you
reading.
spend money now, the price of goods and services may go up by the time you have paid back, so your money's original purchasing power would decrease. Thus, interest rate protects against future rising inflation. A lender such as the bank uses the interest to process account costs as well.
So this is just a general information. The inflation also goes up. So the inflation, the interest should take care of the inflation. Okay, if the inflation is 5%, then the interest cost has to be more than 5%. Otherwise, bank is not going to make money. Similarly, when you deposit money with the bank, they give us 7%, because if the inflation is 6%, we are earning real by 1%. That's why you go and deposit and make a fixed deposit. If the deposit rate is 5%, inflation is 7%, nobody is going to put money in a fixed deposit. Okay, how interest rates are determined? Okay, now I'm just going to talk about. Okay, so there are many factors. How the interest rates are, why? Because interest rate keep changing. They go up and down, go up and down. So first is supply and demand. So for anything, the normal criteria is supply and demand. If there is more demand of loans, then the interest rates are going to go up. Okay, fine. So and inflation. So these are basically two factors. Okay, demand. Just read the demand supply box.
Supply and demand. Demand and supply of money when the economy grows is high. Demand for money increases, pushing the interest rate up and vice versa.
Okay, so demand is going to push up the rate of interest. If a lot of people are borrowing and they have a lot of capex plans, a lot of companies, okay, the capex has not been doing so well in India over the last 10 years. It's the government which is spending a lot of money in building infrastructure. So private capex has not been coming into India, but recently you find it's been taking a up move, and the credit growth is rising for the banks. So that means now banks are lending, and which is going into the in expansion of the companies. Okay, so how the interest rates are determined? So I mean, from where the demand comes, the government is the major borrower, the biggest borrower of India. Who buys? Who takes loans? It's the corporates, government. Okay, so government, takes a lot of loans. Okay, they issue bonds. Now, at any time, every time when the budget is announced, at the end of the budget speech, they say what is our fiscal deficit. That means what is the gap between the revenue and the expenditure. So that's called the fiscal deficit. So how that is bridged? Government is going to borrow money, okay, and that is to the tune of about like 13 lakh, 12 lakh crore rupees per annum, which the government buys. Okay, net borrowing falls, but the gross borrowing is about close to about 13 lakh crores, and which is almost like 5 or 6% of our GDP. So real target is to bring down as low as possible. Okay, but they're borrowing heavily. So almost like 10,000 crores per week, government is borrowing with the help of RBI by issuing bonds of 1 year, 2 year, 3 year, 5 year, 10 year, 20 year, 30 year, like this. Government issues bond, and the bonds are generally been bought by the financial institutions. We also buy bonds. We can even directly buy bonds, but we always buy mutual funds which are investing into bonds. Okay, so whenever we are taking buying a fixed income security, when we want to put our money in interest rate instruments, we buy mutual funds which are actually buying government bonds. Okay, so we have our exposure to these government bonds also. But the banks, institutions, they have to buy it because they have to maintain certain ratios, you know, SLR ratio and all those ratios which government announces, which RBI announces. So they have to keep the money in form of GSECs or government bonds, because they can't lend everything. If suppose they have got 100 rupees from depositors, they can lend say 90 rupees only. 10 rupees should remain with the government in form of bonds, so that to protect the people. If suppose there is something happens with the bank and it becomes bankrupt, so it has certain cushion with them. Okay, so biggest borrower is the government. Okay, then central bank actions either by printing more notes. So either the government can print more notes to take care of the money requirement, or they can issue bonds, or they can do OMO operations. Okay, open market operations, where they can either buy or sell bonds in the market. So changes in the key rates like CRR, SLR, repo rates, this can also affect the interest rates. If the government goes and increases the repo rates. Okay, so repo rate is basically the short-term lending rates at which the banks can take money from each other or from the central bank. Okay, so if the repo rates are going up, then it increases the interest rate. 11 or maybe I think 15 to 20 times RBI has increased the repo rates over the last 2 years. Okay, so it started with 4%, now it's close to about 6% and more. I don't remember what is the repo rate now, but it has gone up by almost 200 to 200 basis point. So this can impact the this thing, the cost. Okay, fine. So basically, if the government thinks that inflation is going up, the economy is too much heated, so they can always increase the repo rate so that it cools down the market, inflation comes down. And times when inflation is down and they find that the economy is not growing, so they may decrease the repo rates so that it propels the growth of the economy. So people borrow more and money, and they can buy either personal loans or housing loans or corporate loans so that they can grow their companies. Okay, fine. So open market operations, might have done it in your one of the course. I'm just skipping. So government borrowed 15.4 lakh crores. Okay, they have a plan in this budget to borrow. So they are the major borrower in the economy. Okay, so always the finance minister is going to announce how much will be our borrowing program right at the end of the budget speech, and she is going to tell you how much is the percentage to the GDP. Okay, fine. So it is 5.9%, but the target is to reach to 4.5%. So more it will cause inflation. If the government borrows more money, it increases the money supply in the country and causes inflations to go up. Fine. So right at that time, Hanji? Yeah, absolutely. The cost of borrowing goes up, basically. Cost of capital goes up, and then the whole of the expansion, falls for all the companies. Okay, so companies won't grow. There will be less jobs. You will find, companies are not coming to the campus if, they are finding very difficult to do business, and they can't, raise capital. If they have to raise capital by, through borrowings mode, then they can't do it. Okay, because the cost of capital has gone up. So there, like Sitaraman, like the finance minister, when they announced that the suppose any finance minister, when she's announcing the last this thing, she says that this is my borrowing program, and if the borrowing program is very reasonable, okay, and very good, and it is say close to 4.5% of the GDP, you will suddenly find the Sensex rising. Okay, immediately after announcement of the borrowing program, the Sensex makes a jump or falls. Either it goes up or falls. It depends on what is your fiscal deficit and how you're going to meet that fiscal deficit, how much you're going to borrow. If you borrow more, then the government becomes more vulnerable. If you borrow more, it's not a good thing. So stock market is going to not give a thumbs up and it may crash after hearing that news that we are in a very bad situation. But if she says that we are going to borrow and it is less than what we borrowed in terms of percentage, of course, in absolute terms, the borrowing always goes up. But in terms of percentage, if it's come down, so the markets are going to take a jump in this thing. So hedging. Now we come to our main topic: hedging interest rate risk. So there are various methods. Forward rate agreement, okay, which maybe we'll do next time. Today, then there are interest rate futures, interest rate options, interest rate swaps. So normally, in your this thing, interest rate swaps are, question always come in your exam. So we are going to straight away do that topic. If time permits, we are going to do other instruments also. So interest rate swaps are OTC derivatives. That means you don't have to go to the stock exchange for doing it. Only two parties have to come together with the help of a banker or with an intermediary. Okay, just read it.
IRS are contracts entered between two counterparties under which each agrees to make different payment to the other for an agreement based on the notional amount of principal. One party makes a payment at fixed interest rate. In exchange, this party makes payment at a floating rate from the counterpart. Floating interest rates are variable and pegged to a specific index such as SONIA, SOFR.
Okay, now there is a big development which has happened in this market. We used to have LIBOR, so that has been now taken off. New instruments have come like Sonia and SOFA. Okay, we are going to study that, and there is not much material which is available in the textbooks or anywhere in the world, except you have to Google and use artificial intelligence for understanding what kind which is happening. If you go to the RBI site, it's still India is still working. They have not come out with a replacement of the LIBOR and MIBOR. I'm going to talk about what it is. Just before that, long back, about I think 25 years, if I remember correctly, I was making a house in Gurgaon. So I needed a loan of 50 lakh rupees. So, and there were other people. I was working in Idea Cellular at that time. Now it's called Vodafone Idea. So a lot of people, they were also interested, my colleagues. So, there were about, I think, 15 of us. We wanted to go and buy a house and take a loan. So since I was, in the finance head, so they said, negotiate with the banks and find out what is the best thing we can do. So I called, bankers, Standard Chartered Bank, HDFC, ICICI, and almost 5 or 6 bankers, they turned up. So, and we were all about 15 people and taking, a loan approximately about 50 lakh rupees each at that time. Of course, now people take 1 crore or 2 crores because, that time the houses are cheaper, talking about 25 years back. So, then the banker came and one of the bankers said that we can give you 2 types of loans. Okay. One is called the fixed loan, fixed rate, and that is called the floating rate. Okay. So he said we are charging, 2 rates, floating rates and fixed rates. So you can choose any. So, I have to take 50 lakh rupees loan for 15 years. Okay. He says that the floating rate loan is 6.25%. And this was the time when we had the lowest interest rate in India ever. After that, we have never reached that. Today, if you take a housing loan, it's cost you about 8% thereabout. So it was 6.2%, the lowest at that time. Okay. For the fixed, he said we are going to charge you 7.25%. Okay. So he said there are 2 rates available, 6.25 and 7.25. So I called everyone and these are the best rates we are getting. So I said, we have to choose either a floating rate or a fixed rate. The floating rate is very good, 6.25. Let's go for floating. So out of 15 people, including me, 14 people had gone for floating. I had taken fixed rate, 7.25. And a lot of people criticize me, why I'm paying 1% higher. I have no clue, but I took 7.25%. Maybe I had some kind of this thing that let's go for fixed. And tell you, what happened. After 3 years, the rate of interest happened to go to 12%, the highest. So these people were taken floating, they were paying 12%, I was paying 7.2. Okay. And for whole 15 years, I paid 7.25. The rates have gone up, from 6 to 12, and then they went back to 8% minimum. So I was still paying the cheapest. I, a lot of people call you up and say that you want to, I mean, we are going to give you a loan, so you can, we'll take your old loan and take it. And they always want to sell, like, I've taken from Standard Chartered Bank, HDFC people, the loan from your standard to HDFC. I said, before doing that, please check what kind of a loan I'm taking. So when I tell them, they used to keep the phone down because they could do anything, because my loan was 7.25%. Nobody could match that rate. Okay? Because if the rate of interest is 12%, nobody is going to give me a loan at 7.25%. Okay? Yeah.
Does that make the bank will make loss on
Agree?
Does that make the bank will make loss on your loan?
Bank is definitely going to make. Now, what has happened is, nowadays when you go to the bank, so banks have suffered losses in that era. So now the banks are giving you fixed and floating, and fixed that stopped also for a while. But now the fixed loan will be only for 3 years. After 3 years, those rates are going to be reset for the borrower. So during my 15 years tenure, I keep checking with the bank. Are you charging 7.25% or have you reset? No, because your agreement says that will be for the full 15 years 7.25%. But now the banks, they can't incur losses in the rate of interest 12%. They are still charging 7.25%. So what they have done is, now if you take a loan from a bank, they say this rate is only applicable for 3 years. After 3 years, the rate will be back to the current rates. Okay? Just to avoid such kind of a thing which happened in my area. Okay. So there is always a floating rate and a fixed rate which is available. The idea was to tell you that there is always a floating rate and a fixed rate which is always there now. If you expect the interest rate to go up, which kind of a loan will you take? Fixed or floating? Fixed. But if you expect the interest rates to go down, then which rate of interest will you take? Floating. So that means if you have taken loans, and a corporate takes always loans, okay? So if they take loans, and some corporates are taking fixed loans, some are floating loans, but the scenario will change. So a company which has taken a fixed, he was saying the interest rates will go up, that's why he got fixed. Now he thinks the interest rates are going to go down, so he would like to convert his loan from fixed to floating. But there is another guy who had taken a floating rate, and he thinks the interest rates are going to go up, so he would like to convert himself into fixed. So there are people of opposing needs in the world, because somebody is buying, somebody is selling. Nobody knows, whether the interest rates are going to go up or go down. I mean, a lot of, clarity people can't. I mean, of course, you can always make some kind of a short-term assessments, okay? But people can have different views over the interest at the same time. One person thinks the interest rates are going to go up, the other person thinks the interest rates are going to go down. Okay? So that means an instrument which comes here. Which one?
The interest rates on which loans are given are based on RBLR.
RBI?
RBLR. Repo rate.
Yeah. MCLR. Yeah.
No, RBLR. It's changed.
Okay.
Now they don't give out all this.
Fixed rate they are not giving.
All the loans which were previously, I worked in a bank. So all the loans which were previously on fixed rate of interest have been.
So that is RBI. Okay, because right now because they are still in a transition phase, so they have stopped it for a long time. So because we have not moved on to the new rate has not come, but when you are taking loans in the international arena, you can go for a fixed and a floating. But when you're talking about only India, where the RBI have put a pause on a fixed loans, okay, or on they are just giving loans on a floating. So let's talk about that. So interest rate. So IRs are contracts entered into between two counterparties under which each agrees to make a periodic payment to the other at an agreed period of time based on a notional principal amount. So that means we're talking about interest rate swaps. Okay, so that means they have to be two parties and they'll be exchanging certain, they will have a contract. Okay, so one party makes a payment at a fixed interest rate. In exchange, this party receives a payment at a floating rate from the counterparty. Okay. Now, I'll just explain this through an example so that you understand. And the floating rate interest rates are variable and pegged to a specific index such as SONIA or SOFR. Earlier, there was something called LIBOR, London Interbank Offered Rate. Okay. Like similarly, we have, it's, similar type India, Mumbai Interbank Offered Rate, which is called MIBOR. In Japan, it will be TIBOR, Tokyo Interbank Offered Rate. What we'll do, like, let's talk about, say, LIBOR in England. like in the morning, there would be one agency, which was earlier Reuters, then International Exchange. They would call up, all the bankers and find out, if they have to lend money to each other. That means interbank lending for a period of 3 months or 6 months or 1 year. So what kind of rate they are going to charge? Okay. So they will call up at least 20 big banks in England and note down all the interest rates, how much interest they are going to charge, short-term interest rates for 3 months. Suppose you have to give a loan to someone for 3 months. What is the interest rate? What you are going to charge? So they'll ask this question and note down that interest rates. Okay. Of all the 20 banks, they will exclude the outliers who are charging either more or very less and take the balance number. Suppose it is, for example, 15 and make an average of that. Okay. So that average, suppose it works out to be about 4%. So they say today the LIBOR is 4%, and they will publish that in the internet. Okay. And they will, announce that into the public that this is the rate of interest which is for today. The LIBOR is today 4%. So what they'll do, they'll make a phone call and work out the rates what the banks are going to charge for lending the money for a short period of time. Okay, they're going to note down, take an average, and publish that number in the newspapers those time. Now, of course, through internet, they are relayed to everyone. But these are the rate at which the banks are willing to lend to each other. So the LIBOR was an interbank rate. Okay, that means if one bank has to borrow from another bank, what is the rate at which they can borrow? Okay. Now, suppose if the bank can borrow at 4%, suppose if I go to the bank, suppose I am representing Reliance Industries, I need, 1 billion of loan, $1 billion of loan, or 1 billion pounds of loan, or whatever. So the bank will say it is going to LIBOR plus 2%, because 4% is their cost. Okay, 2% is their spread. Okay, now it can be LIBOR plus 2%, LIBOR for 1%, depending on the borrower. Like Reliance would negotiate at LIBOR plus 0.5%. Whereas a smaller company, they have to pay LIBOR plus 2%. Have you got what is LIBOR? LIBOR is interbank lending rate among themselves. It is based on the phone calls which somebody has made, like Reuters or Intercontinental Exchange, and got the numbers from those banks, did the average of that, and then they say this is the LIBOR. So bank would assume this is the LIBOR. Okay? And they would quote this rate plus some additional amount of spread so that they can cover the cost. So if somebody comes like person like Reliance, which is a big borrower, they want to borrow in dollars or pounds, so then the bank will say LIBOR plus 2%, LIBOR plus 3%. So depending on the borrower performance. So that's a minimum rate that the bank can charge.
What is the need for deciding that spread? Because
it is again because of the credit worthiness of the borrower.
It has to be spontaneous. So
yeah, absolutely.
How is it?
It's on, the banks have their, this thing based on the credit rating of the person. They have actually made a spread. Like a person which is having a triple rating, the spread will be 1%. For a rating which is say double A, the rating will be 1.25%. So as the rating comes down, the spread goes up. Okay. So they have some kind of this thing benchmark on which they decide. That has gone now. Okay. But anyway, still there's something still there. So now this was based. There was a scandal in America and other countries, because these rates were given after making a phone call. Some people can also manipulate the rates. I'm not going into the scandal, but the whole thing was to stop this LIBOR business in the world and come up with the new rates, which are actual rates, not just the actual lending rates. How much the bank is charging actually, okay, which should be backed by transactions rather than backed by word of mouth. So the rates are called SONIA and SOFR. Okay, SONIA is basically, I'll tell you the full name of that. It is given on the top, I think. No. So SONIA is Sterling Overnight Index Average. So again, it is an average, okay, based on actual transactions of banks lending to each other based on the transaction. Similarly, secured overnight financing rate. This is the rate published by Federal Bank. Okay, the first rate is published by the Bank of England. The second rate is published by the Federal Reserve, which is the America. Okay, and this is based on the actual transaction happening there. So we're going to understand that later on. What are those actual transactions? Okay, so these are the rates. Fine, is that okay? So these are the rates. Like currency quotes US dollar USD. It was earlier, the rate was USD LIBOR. Now it is SOFR, SOFR. And then, the pounds, the rate was GBP pound, which was LIBOR. And then now it's SONIA. So there was a LIBOR in America, LIBOR in England, LIBOR in everywhere. Okay. Like India, it was MIBOR. So in Europe, it was Euribor. In Japan, it was TIBOR. And now it has become by different names everywhere. So these are actual lending rates. Okay. Fine. Is that okay? So interest rate swap. So let's understand an example, and then we go and understand what is Sonia, what is SOFR, and what is the new which is going to come in India. Okay. So when both the legs are same currency, this notional amount is typically not exchanged. So we are two parties are going into enter into a contract with each other. Okay. So they are going to decide about an amount. What is the amount? 1 crore rupees, 50 lakh rupees, 25 lakh rupees. It can be in dollars, it can be pounds or whatever, Indian rupees. So they're going to decide about. Suppose I have a 1 crore loan. Okay, I would like to have interest rate swap with another person who is interested in 1 crore this thing, because I want to protect my 1 crore interest what I am paying. So we have to, first decide about the notional amount. Why it is called notional? Because the amount is not exchanged. The amount which I have taken from the bank, okay. But now the two parties, privately or with the help of a banker, they are entering into a interest rate swaps, okay. So they don't exchange the principal, okay. That's called the notional amount, but it is used only for calculating the size of calculating the cash flow. So only the interest is exchanged, okay. So we can, when of course when it is in two currencies, like there's a person in America, there's a person in England, they are entering into interest rate swaps, then they are going to have even exchange the principal amount at the beginning, and at the end they are going to again exchange. One is going to pay, then at the end it's going to be repayment is going to happen, okay, as if the loan you make a loan. So we are going to understand interest rate cross currency swaps, this fag end of this thing. First we are going to understand the notional, where the principal is not exchanged. Whenever two currencies are involved, then notional principal is exchanged, otherwise not, okay. For example, okay, parties involved. Suppose there is one party currently has a loan linked to Sonia and wants to switch to fixed rate. So Sonia is a variable rate. Okay. So he has a loan which is linked to Sonia. The Sonia rises, his interest cost is going to go up. It's like a floating rate, and he wants to convert himself to fixed. And party B currently has a fixed rate loan and wants to switch to Sonia. So two people with two opposing needs. One is in Sonia, another he wants fixed because he thinks the interest rates are going to go up. The first party would be that the interest rates are going to go up. That's why he wants to switch from Sonia to fixed. The other party, he feels that the interest rates are going to drop, so he wants to switch to Sonia. He has already a fixed interest, taken fixed rate. So party A has a loan with interest rate linked to Sonia, reset periodically. Now, Sonia is again reset after 3 months. Okay, fine. If the Sonia goes up, then he has to pay higher price. Suppose bank says Sonia, it's linked to Sonia plus 1%, for example. So he's going to be charged Sonia plus 1%. Every day the Sonia is published, but every day his rate of interest is not going to change. It has to change after a periodicity, after a month, after 2 months, after 3 months. Okay, so it is reset periodically. So the borrower doesn't have, the interest cost is not going to fluctuate every day. So the Sonia is going to be reset periodically. Party B has a fixed rate loan with an annual interest rate of 3.5%. So other party has taken fixed, one party has taken ये क्या हो गया? हाँ, अच्छा लूज कनेक्शन है. Is it okay ना? Okay, हाँ ये थी. Even the battery is also. So class is up to what time? 12:15. 12:15, yeah? Okay, so I'll cover this before the close. So, structuring, now the question may come that, you have to structure an interstate swap. Able to see it? दिख रहा है? Okay, so let's talk about. So A has taken a Sonia and party B has taken a loan at fixed rate. अभी भी ये यहाँ चल रहा है, वहां से बंद है. So just focus there only, okay? Fine. So notional principle. First, we have to decide the notional principle. So here the notional principle, which is decided, 15 million pounds, okay? Swap period. So we have to determine for how long the swap agreement is going to happen. So they have chosen 5-year swap. Fixed rate. Party A agrees to pay a party B a fixed rate of 3.5% annually on the notional principle. Party floating rate. Party B agrees to pay party A the compounded. So it's like this. So I'm just showing the final slide. So what happens that here, can you see this? So here, A has taken a loan from the lenders. So they are paying Sonia 0.2%. Okay, so this is what they are paying to the bankers, and party B is paying 3.5%. So what they do, they make a swap agreement by which party A is going to pay 3.5% to party B, and party B. What will happen? The party B pays to Sonia 0.2, so they pay to the bankers. They are paying now fixed, so they are now fixed. Party B is now actually be converting them into Sonia. Okay, by having this swap agreement, they actually. Can you see this, all of you? So what they have done, they have entered into a swap agreement for a period of say 5 years for 50 million worth of this thing. So it is going to happen only, no exchange of principal, only they will work out the amount and they are going to share. Only the net amount is going to be either given or taken, depending upon the stoning. What is the rate of stoning? Principal has to be same. Both parties have to decide. Now, suppose I have taken a 1 crore loan, for example, 50 million pound. Other party has taken 30 million pound. So they are going to 50% help themselves. I am going to 100% help myself. So for balance, they are going to look for some other part. Okay, fine. Is that okay? Now, two parties have entered into similar notional principle. So one person will be here, another person will be half here or not here, depending on his exposure. So he feels that he have 50% exposure here. So he can have 50% exposure. The other party might have taken a loan of 30 million from the bank. He says, I'm going to pay a 50 million pound loan. I'm going to hedge. So they are going to enter into a swap agreement so that they exchange money in such a fashion that their obligations shift from fixed to floating and floating to fixed. Okay. So party A, can you read? Just read it loud.
Party A achieves fixed interest rate payments providing predictability. Party B accepts the risk of interest rate fluctuations and agrees on a fixed rate principal.
So have you got everyone? Is there any question? Have you got what I have done? समझ आ गया ना? How they have changed their this thing that you have understood. Okay. So now we talk about ये क्या हो रहा है देखो. Sterling overnight index average Sonia, what it is. Okay. So there's a theory there. I have just given you. Sonia, then the key features of Sonia, then the secured financing over rate that's in Federal Reserve. So I'm just going to talk about this theory in my next lecture. So let's the MIBOR has still not been replaced. So this is the MIBOR, which is still the RBI is working on it. So what should be the appropriate short-term lending rate among the banks? Okay, so they're still working. So we are going to cover that. So before hurriedly, we just do one more question, okay, which is very important because this will be part of your exam. And next time we're going to understand about Sonia, MIBOR, and so far more in detail for your this thing. Or you can just go through my slides, okay, when I share those slides. So somebody is going to make a WhatsApp group. So I'm going to share all the. Who is going to make it? So just look at it. A borrows from the market. Okay, so let's go to the main question. Okay, so now this is very important. So can you read?
Company A expects interest to decline and wants floating rate borrowings. The company B expects interest to rise and wants locking fixed rate available to it.
Is that okay? So both have, they have different kind of loans and they want to shift from fixed to floating or floating to fixed. So, these are the rates which are given by the bankers. So credit rating of company A is A and B is B. So A means high rating, B means low rating. So A is a strong company, B is a weak company. So fixed rate is 6% offered to A, and for B it is 8%. So if company A takes a loan, he will be charged 6%. If company B takes, they will be charged 8%. So floating rate is also given, SONIA plus 1% and SONIA plus 1.5%. Okay. Okay. Now A expect the interest rates to decline and wants floating, whereas B expect the interest rates to rise and wants to lock in a fixed rate. Okay. So these are the things which are given by the banks. So they are trying to structure a deal so that they can lower the cost. Okay, fine. So company A has an absolute advantage because he is being charged 6, okay, whereas company B is being charged 8%. Okay, he is again for Sonia is being charged 1%, Sonia, and that person is going to be charged. It's a rate. It's a rate which will be published. It can be 3%, 4%. It's an overnight lending rate. Okay, it's an interbank lending rate. Fine. Fine. Now, company A having an absolute advantage of 2% in fixed rate. And floating, they have a 0.5% advantage, isn't it? So, company B is having a comparative advantage. Okay. Why? Because company A is being offered only 1.5% against 1%. There is a half a percent more. Whereas in fixed, there is a 2% gap, isn't it? Fixed में 2% gap है, floating में सिर्फ आधा % gap है. So there is a advantage of 1.5% altogether. Just listen to me and you'll understand. So although company A wants to borrow at a floating rate, but plans to borrow at a fixed rate and then swap its cash flows with company B that wants to do the opposite. So they are going to borrow, in the rate, what they don't want to, but because it is working out cheaper for them, so they are going to. So both companies intend to lower the borrowing cost and wind up at the type of borrowing that they wanted to be first place. Okay. Ultimately, they want to be in their own this thing, but they are going to borrow at a different this thing, what they actually intend to buy. So there is a comparative advantage created by 1% of arbitrage profit opportunity. So there is an arbitrage profit opportunity which is coming. So first of all, when a question is given to you, you have to find out what is the arbitrage profit. Okay, fine. So पहला काम है arbitrage निकालना. उसके बाद answer becomes very easy. We'll assume both the parties will split. So I'm going to cover this again the next time, so that if I'm just doing it in a hurried manner, so next time I'm going to repeat it. We will assume both the parties will split the arbitrage profit evenly. अब 8% का फायदा हो रहा है. They said, okay, we'll share it 0.75% equally. If in question it is given, nothing is given, split it equally. If you're not able to do it because you're not able to work out, so whatever comes, you say party A is going to get 1%, party B is going to get the benefit of other 0.5%. So if you are able to structure, because there is no way method, it's all done by hit and trial method. Okay. So thus both the parties are going to lower their cost by 0.75% because there is an arbitrage. Okay. Now they enter into a swap deal. So this is what they were paying. Okay. Company A borrowed at 6%, company B borrowed at 1.5%. So now what they did was they entered into a swap deal where the company A is paying Sonia plus 0.5% and company B pays 6.25%. Now how it has been arrived, we'll just know that. So which means company A will now have Sonia plus 0.25%. Okay. Company A will have Sonia because now he is going to get 6.25% from company B and he is paying 6% to the bank, so he is saving 0.25%. So Sonia 0.5% में से 0.25 निकाल दिया, so ultimately he is going to pay only Sonia plus 0.25%. Is that okay? And other party is going to pay 7.25. If he had taken the loan himself to the bank, he would have paid 8%. So he has lowered the cost by 0.75%. And if A would have taken the loan himself, he would have placed Sonia plus 1%. Now he has reduced his cost to Sonia 0.25%. Have you got it? Of course, when you go through the example clearly, you will understand that. So how it has been done, this is the chart which explains. Company A, fixed cost. So he's, company A pays to the bank and gets, company A pays 6%, but he's getting it from party B 6.2. So he's selling 6.2 in the fixed. Then company, the floating rate, he's getting another 0.5% advantage. Total advantage is evened out, so 0.7. So here A pays Sonia plus 0.5% to B against Sonia plus 1 offered from his banker. So bank offered him Sonia plus 1, but he's paying Sonia 0.5. So that means he is getting 0.5%. So here he's also getting benefit. So total benefit is 0.75%. Here This guy was supposed to pay 8% to his banker. He is now paying only 6.25. So he is saving 1.75. And here he is paying, to him B receives Sonia plus point against. If he borrows directly, he has to pay Sonia. He has to but he has to pay Sonia. So he would have B receives Sonia, but he has to pay this thing. So he's losing point minus this thing. Okay, fine. So overall, there is a benefit which has been transferred because of the arbitrage, benefit. Okay. So I'm just ending. Next time we are going to understand it a little bit more deeper. Okay. So the question would be in your exam to structure a swap deal. Okay. Some information will be given to you. The information which I have provided, and you have to structure a swap deal so that they both can share. आपने वो बना दिया WhatsApp group बना दिया? हाँ. You will just forward so that I can just share the slide for the day. Okay. So that you can just go through and understand. I hope you could understand. I mean, was it easier? Of course, last we did very fast, so maybe whole idea was to see that we just conclude whatever is the most important part. But next class we are going to have, because next time we are having a 2 hours class. Okay. Next